Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Affirm. So what's Affirm? What its growth prospects are like? One of the things that I'm kind of unsure about in terms of its profitability. Finally, we're going to bring this all together and talk about its valuation and some aspects here that are kind of worthwhile considering. So Affirm is a payment solution provider. It's a leader in the buy now pay later scheme. So Affirm's stock has really taken a tumble. In the last 6 months, it has just come down approximately 40%. And if you think about it, on the day of this IPO, the stock was up quite significantly. It was up, I think, if I remember, 100% or so on the day of the IPO. People were just clamoring for the stock, PayPal mafia. It was just people were going crazy for the stock. And now it's kind of, things have moved on, and you got hit with the inflation, trade worries, and then now Apple coming in with its own version of Apple Pay. It's just so the stock has got a bit kind of shaken off. Now, if you're an investor, if you're gonna be paying up for a growth stock, this is part of the territory, right? So you're always gonna have competition, and it's very difficult when you're paying for a large multiple for a stock for it to be just seamless. It's gonna be difficult. So if anyone is kind of out there and kind of unsure of it, I just say, don't sell into bad news. Stay the course. You make your return on staying with the stock, not on the buying and the selling. So I hope that kind of gives you some context. Now, here's the thing. At the surface level, as you can see here, Affirm's revenue growth rates are very bumpy. However, it's Q4, so it's the quarter just finished now, just in June, Q4 2021, it's still pointing for about a guidance of about 47% year-over-year growth rate. So it's definitely growing very fast. And if you look back to Q4 last year, that was a very strong quarter. So any comparison against that quarter would have been really difficult. So for Q4 this year, for it to still be growing at approximately 47%, it's quite strong. And I suspect that when the results should probably come out in the next 3 or 4 weeks, and I suspect that when they put out the guidance for the next quarter for Q1 2022, it's going to be slightly better. I don't think that it's going to be as bumpy as this has been. So it's been a bit of a turbulent period. Now, here's the thing, right? So when a firm comes to take a charge from the gross GMV, gross merchandise value, it has been increasing steadily over time. So that take rate has gone from about 3.5% last year to close to high 5% this year, and even nudging close to 6%. So it's doing really well with the increasing stake rate, and it's still been able to increase the number of active merchants close to 100% year over year to 11.5k, close to 12k. So it's grown its number of active merchants. It's also been able to increase its take rate. That's a very healthy business model, I suspect. Now, a problem that I've got is that it's one of those high-flying stocks that's really, really negative. And if you think about it, even though it continues to grow, its adjusted operating losses, so after all those pesky costs get added back, is still quite negative. So for the quarter that's coming up now, fiscal Q4, it's pointing towards approximately negative 50 million. And if you think about it, last year for Q4, it was positive 47 million. So although it's growing very fast, it's not really being able to have that positive operating leverage. So at what point does something like Affirm come up with, let's say, sustainable, consistent 5% positive operating margin? I think it's going to be difficult, and probably even if you look out 2 or 3 years from now, it's kind of dubious if that's going to be. If we can get to close to 5 or 10% operating margin, that's really fantastic, but it still has a lot of stuff to prove for itself. Now, here's the thing, right? If you take Affirm's revenues, the stock is priced at approximately 19 times sales this year. So it's finishing this year, as I mentioned already, and if you look out for next year, approximately 13 times forward sales. Okay, so that's not too expensive for a company that's growing at close to 50% year over year. So that's right, that's fantastic. The problem is that of Affirm's revenues, close to 56% are made up of transactional costs. This is like provisions against credit losses, funding costs, servicing charge, processing fees. So some of that are management's estimates. So over time, as management gets more and more first-party data on the customer, they can bring that down, possibly. But things like funding costs and processing fees, that's going to be a variable cost. So as the revenues go up, this is going to just tail that around. So I don't see how it's possible for them to really get very strong revenues. It's going to be difficult because there are so many servicing costs attached to this. So the way I think about it is, if you look at, let's say, how the company talks about revenue less transaction costs, the stock then trades at 46 times forward sales. This year's sales. So it's 46 times. It's kind of punchy. If you want to compare, if you want to think about this, I think in my mind it's like kind of like gross profits. So if you look at PayPal trades at approximately 32 times trailing gross profits. I just kind of looked at its trailing gross profits for the last 12 months. I don't have no idea how its guidance is going to be for that, but just that gives you a kind of a ballpark. So if you look out to next year, probably that dips to around probably like 26 times or so forward gross profits compared to Affirm's 46 times. So it's an expensive stock. Also, if you compare with PayPal has a free cash flow margin of approximately 24% for 2021. They actually have a normal calendar year. So PayPal is a well-established blue chip company with reasonably strong growth. If I remember, it's around 26% to 28%. So it's growing quite strongly. It's free cash flow generative. It's going to make about 6 billion of free cash flow, and it's not that expensive. So Affirm is the up and coming, and it has a great management team, but it's an expensive stock. So, but again, the stock has come down quite significantly. So you have to kind of just think about that. Yes, it is going to be difficult if you're a shareholder in the stock right now, because you're going to be getting hit with so much bad news out there, and for you to stay the course is going to be really emotionally challenging. That's why I kind of prefer, if I'm going to go into these kind of battleground stocks, I prefer to pay a smaller multiple. At least it gives me a little bit of wiggle room in terms of margin safety. And as always, don't forget to check out my marketplace called Deep Value Returns. You're welcome to do a totally free trial to see if it suits you. If you like it, stick around after the 14 days. If you don't like it, cancel anytime before 14 days, then no harm, no foul. At least you gave it a shot, and there's not a lot to lose there. As always, I hope to see you next time.